Hi everybody, we're live, covering the Federal Reserve today in the middle of the war. I'm Yohay Elam of FX Read, and with me is Ian Coleman.
Hi guys.
So we have a critical decision because the Fed is the world's most powerful central bank, and today it's set to leave interest rates unchanged, but it matters a lot what it says about everything related to the war. Basically, two scenarios. Does it see inflation coming from energy, from higher oil prices, as meaning higher interest rates, or will it choke that much to the economy that it means a recession, or something in the middle? Let's wait and see. They could go for this approach as well. But of course, we already talked about oil and the war. Today we had big news from the war. Israel attacked an Iranian oil field in the gas field, in the Persian Gulf called South Fars, and Iran said it would retaliate, hitting upstream oil and gas installations in neighboring countries, Saudi Arabia, the Emirates, and Qatar. Ian, what do you see on your charts regarding oil?
Well, it's going to be busy. That's one thing that we know. We've got a high volatility at the moment. Firstly, I'd like to say welcome to the second FX Street live show. As Yohay's already mentioned, we're going to be covering all the macro releases. We're live on 3 platforms. We welcome your participation. Hopefully, you've got lots of questions for us with regards to macro and technical setups. With regards to oil, obviously we'll be covering gold. DXY is quite interesting, which is the US dollar index. I'll be covering euro dollar, sterling dollar, dollar yen, Aussie dollar, oil, obviously, stock indices. Got an interesting setup also on the DAX at the moment. Oh. So over the next 60 minutes, there's going to be, a lot to take in.
Yeah, and before you dive into the first chart, I'll just mention the timetable. We begin now around, we have 18 minutes, the Fed decision, expected no change, but they release what's called a dot plot, which is a forecast for interest rates and other things. Markets foresee only one interest rate cut. Half an hour later, Fed Chair Powell will deliver his press conference, and he'll get lots of interesting questions. We'll be jumping between both of them, and we'll also have special guests between the decision and the statement. Ian, any nice charts?
Yeah, I've always got some charts to look at.
Maybe we'll begin with gold because we have lots of gold questions, unsurprisingly.
Okay. In fact, I'm going to throw a bit of a curveball in here. So I'm actually going to start with DXY. So DXY is the dollar index for those that don't know, and it's a dominating factor with regards to most products, most dollar denominated products. So if DXY goes up, then gold has a tendency to go down, and inversely, obviously, if DXY goes down, then the gold has a tendency to go up. So the first chart that I'm going to show on the screen is DXY. This is the dollar index. Just be careful here, as we've mentioned before, different brokers have different levels for DXY, but it is a basket of dollar denominated currencies. And here we can see that we had a very large range last week, and all we've done this week is stay inside that range, and that sometimes happens when there's periods of indecision. Obviously, markets are on hold going into this Fed rate decision today, and there's different views. Okay, sometimes we can get quite a decent technical view going into a release. Sometimes the picture's not as clear, and as I was just mentioning or having a conversation with Yohay just off camera before we went live, that I believe this could be a muted response to today's interest rate decision, and even Powell's speech and Q&A afterwards. And the reason behind that is there's a lot more macro forces happening behind the scene, obviously with what's happening with the war, with oil, with risk on and risk off.
Yeah, basically the US dollar has emerged as the winner from this war, gaining in times of trouble, sort of reasserting its safe haven role. Well,
Sure.
when markets are a bit calmer, foresee a quicker end to the war, the US dollar gives some ground. Back to you, Ian.
Yeah. So the DXY at the moment, we're in this sort of mid range of last week, and these are known as inside candles, and it basically highlights indecision. Obviously, we sometimes just get this indecision on a run up to big events, but what I believe is going to happen in DXY is that we're going to get this high volatility. So what happens quite a lot through Fed decisions, I prefer CPI because a non-farm payroll, because we just get the decision, we get the reaction, and there's no follow through. In when we have the Fed interest rate decision, we obviously have the presser afterwards where Powell answers questions, and that can then cause whipsaw. The initial reaction can get reversed. So it's a much harder, as far as I'm concerned, as a trader and a technical analyst, it's a much harder event to trade. Yeah. And what I believe we're going to see is potentially a move to the downside first in DXY, and then this pop back up to the upside after or during the Q&A. So my bias at the moment is basically for dips to be bought. So as a technical analyst, I would look at a chart and say, what is the favored trade? And for me, the favored trade would be for the dollar index to move to the downside, to hit some support. We've got some support in DXY between 98.82 and 98.36. So this quite decent range here. That conversely should then, in gold, what we should really see is DXY moving to the downside, gold pumping higher, but then pumping higher and getting rejected and then moving lower. So we really should then look at what's happening in gold. So I'm not going to look out to a longer time frame, because a longer time frame is actually quite mixed. But the intraday chart, what we've seen this 5-wave pattern to the downside. Now, Elliott wave analysis would suggest that that's the end of one cycle. We then saw this choppy correction to the upside. This is known as a corrective channel formation. We've moved lower, but it looks like we're going to continue to see volatility. So potentially a spike to the downside towards support. We've got support located at 4,795, and then a move to the upside. So as far as I'm concerned at the moment, gold is really sort of mid-range. It doesn't really give a strong signal going into the figures. It could dip to this level and then bounce higher. It could also move up to resistance and then project lower. So again, it's going to be a high volatility event, and there's no clear picture in gold at the moment. I prefer other studies, put it that way, or other assets to concentrate on.
Yeah, we have a question here about the question is, do you think due to the rise in oil prices and inflation, will the US delay the only rate cut in 2026? I think that in general, everything is on ice. Fire in the Middle East, ice at the central bank. There's high uncertainty. As Ian said, there's lots of uncertainty. There's room for whipsaw. In general, if oil prices remain at high levels for 4 to 6 weeks, as the White House talks about the length of the war, that's just a small spike. Maybe it'll propagate into costs of other things because everything is transported using fuel. But so maybe it's gonna delay the one rate cut a bit, not a big deal. But if the war continues and there's a crunch of oil in the world, then inflation could spike so much higher and cost so much that people won't have money for other things. That means a recession. And in that case, the Fed could cut interest rates. My forecast for the Fed decision is that they'll say, well, it's not only even 3 weeks. There are so many unknown factors. We'll have to wait and see, and it can go either direction. In general, I think there's a chance that the war will last a bit longer. I want to be optimistic, but I'm not. And that means that eventually we could have a panic attack in markets, and that means potential for recession and Fed pricing in rate cuts. But we're absolutely not there yet. As Jens said, anything can happen. I hope we answered that question. 9 minutes to go. Yen, I see you have another chart waiting here to show us. It's oil.
Yeah, I mean, everybody wants to know what's happening in oil at the moment. Again, we've seen, we've seen consolidation over the last sort of 2-3 days. From this chart, this looks to be forming a flag formation. So this has a bias to break to the upside. And this really goes back to what I was talking about, what my focus is at the moment. I believe we're going to get higher oil, but I also believe we're going to get stock indices moving lower. And the correlated factors between these different assets highlight that oil should break to the upside. This is a flag formation. So the way to trade a flag is that we basically take the length of the flagpole, we take the low of the flag. So this period of consolidation has caused the flag, and then we break to the upside. So the measured move target is around about $122.70. Wow. The reason why I like this as well is because when we talk about sort of liquidity grabs, smart money concepts, etc., what we like to see is a break above previous highs. And the reason why we like to see a break above previous highs is because that's where obvious stop losses are placed. So 119.55 was the previous high for oil, going back to the 9th of March. The stop loss is placed above there. The measured move target for the flag formation is 122.70. The only way that this pattern really gets negated is if we see a breakout to the downside below this flag formation, which is currently at 92.55. Again, I've got to express a little bit of caution here. A lot of different platforms, CFD platforms, etc., have different levels for WTI crude oil. So you've got to make sure that you're looking at the right data. So if you're looking at this flag formation, I'd recommend that you actually calculate it yourself to see where the measured move target is on your platform.
Yeah, and let's mention why oil prices are higher. Basically, I mean, you probably know this if you're not living under a rock. Due to the war, Iran blocked the Strait of Hormuz. That's a critical waterway through which something like 20% of global oil flows. It threatens ships, it attacks other installations over the Gulf. Actually, before today's Israeli attack on that Iranian gas field and the counter threats from Tehran, oil prices were dipping a bit because some of the oil could flow north from Iraq through its Kurdish semi-autonomous region to Turkey and to Europe. And also, Saudi Arabia ramped up this pipeline that goes towards the Red Sea. And United Arab Emirates also is trying to send oil eastwards that avoids the Strait of Hormuz to Fujairah, its eastern port. Iran already attacked Fujairah. The Houthis in Yemen are allies of Iran, and they might attack ships in the Red Sea, which is outside this map. So it's all super fragile, of course. and it could go in any direction. Okay, we have 5 minutes to go. We have a question here about pound dollar, euro dollar, and Aussie dollar. Now, Ian covered the dollar index. I'll just mention that the Aussie dollar is a beneficiary because it exports LNG and a hawkish central bank. The euro and the pound are not doing that great. What do you see on the charts, Ian?
Okay, cipher pattern analysis. This is something that we've covered in some of our videos, educational videos on the YouTube channel. This is the euro against the US dollar. It's a 2-hour chart. Again, similar to DXY, we look to be mid-range at the moment. So we're actually between a resistance level, which is at 115.97, and a support level at 114.60. As I said, if we see downward pressure in the dollar index, I think that's going to be short-lived, and that would mean that upward pressure in euro against the US dollar will also be short-lived. So what I believe is going to happen is that we'll see a move to the down to the upside, towards this resistance level at 115.97, then a push lower towards 114.60, which is a support level, and then potentially quite an aggressive move higher towards 118.30, which will then complete this cipher pattern known as a crab formation. Sterling dollar, and just make sure I've got the right chart here. Again, in between resistance at 113.90, we've got support at 132.78. This dip this morning has found buyers. Again, I think the bias going into the figures is going to be to the upside towards this resistance level, and then potentially a move back lower before we see a break to the upside. Now, Aussie dollar, as I was mentioned before, it's a risk on, risk off currency, and it's slightly diverted from what we're seeing here with regards to other dollar-based products. And if I can get the chart up, this was again a cipher pattern that happened earlier in the week. This is a back formation. It completed at 0.6987. But I think big picture analysis, and sometimes we have to go out to higher timeframes to really see what's going on. We completed a butterfly formation up here, and my preferred stance for the Aussie against the US dollar, and this is really again going back to correlation. This is more about the fact that I believe stocks are going to come lower. So if stocks come lower, the Aussie should get pushed lower. We've got the potential of forming a bearish head and shoulders here. So I'd be wary of these levels, okay, which is around about 71.41, which is a previous swing high and can potentially form a right shoulder in this bearish head and shoulders pattern.
Okay, well, we're less than 2 minutes to go. Remind everybody that the Fed is expected to leave interest rates unchanged. We'll see that very soon on the economic calendar. The Fed also releases what's called its dot plot or forecast for interest rates. Markets expect one interest rate cut this year and no more. And because of higher inflation, while CPI inflation has been relatively moderate, the Fed uses core PCE, which stood at 3.1% last time. The Fed targets 2%, so still a bit too high. On the other hand, latest jobs report was very disappointing, a loss of 92,000 jobs, but I expect the Fed to treat it as a one-off. First, the statement comes in less than a minute with the decision and the dot plot. Markets will likely react initially to the dot plot, but as Ian said, the initial reaction is not necessarily the right one, and we could have a whipsaw. In case we have no rate cuts forecast for this year, 30 seconds to go, then we can see, well, it's a hawkish thing, good for the dollar, bad for gold and stocks. And if they expect 2 rate cuts or more, then the opposite will occur. Okay, so yeah, it's coming up in just a few seconds. Let's see what's going on. Yes, the Federal Reserve decided to leave interest rates unchanged exactly as expected. It now foresees for this year an interest rate of 3.4%. So that is a bit lower. That is well, a bit dovish, which means negative for the US dollar and positive for gold and for stocks. And Ian, what do you see any immediate reaction on the charts? What's going on?
As expected, we're seeing a move to the downside in the DXY, which is the dollar index. It's only gradual at the moment, maybe ticking off 10 ticks, 15 ticks from where we were before. No great market reaction yet, but I think the bias is now slightly bearish for DXY, which should be mildly bullish for gold. Let's have a look, see what how gold's reacting. Again, there's a tiny move in gold. We've moved from $4,891 to $4,897. So we're still, mid-range as far as I'm concerned.
Okay. So for those joining now, the Fed has decided to leave interest rates unchanged widely as expected. And the dot plot points to, well, it's a bit more moderate. Shows it's a bit dovish. So that is a good thing for markets. For now, we're seeing the US dollar a bit lower and gold a bit up, stocks a bit up. The moves, as Ian said, are not absolutely outstanding. We have a question here. Will the Fed lower Bitcoin price? Well, Bitcoin is more correlated to the NASDAQ and in general tech stocks than to macroeconomics. But Ian, maybe you have an opinion about Bitcoin technically? Well, I look at the headlines.
Yeah, Bitcoin has been channeling. So if we get to this chart here, it's been channeling for, well, literally since the 5th of February or February 5. So that's 13 days where we've seen mixed and volatile price action. When you see these channel formations, you really got to focus on whether or not there's overlapping price action or whether or not there's impulsive and aggressive moves in one direction. Here, we've just got very, very messy price action, very hard to trade as a day trader. What we do have is we've got some support at 71,485, and the dip down to that level is actually being bought into today. What a preferred stance purely as a trader and a technical analyst is to try and sell into the completion of the sequence. So at the moment, again, I think we're mid-range. If we put a fib on this, we're probably 50% or close to 50% of this channel at the moment. We've got resistance at 79,175. That is very close to this previous swing high over here. What normally happens is that these areas will attract sellers once more. So the immediate bias for me at the moment is mildly bullish, but from a purely risk-reward perspective, I'd prefer to be selling into cryptocurrencies at higher levels. And I think 79,175 would be a sort of decent area for me to get short. It would highlight that we've seen the completion of this choppy correction.
Yeah. Okay. So basically, the Fed still foresees one interest rate cut this year, left its interest rates unchanged. We had the market reaction. We see some impact on various assets. Let's look at the dot plot. Now, I personally don't, we'll look at the dot plot immediately. We'll first show the table. The table that you can see on your screen right now shows what the Fed is expecting. So this part here, federal funds rate, is the one that causes the immediate reaction. Basically, what you can see is that the Fed still expects interest rates to be at 3.4%, which implies one rate cut. That is exactly the same from December. Looking at growth prospects, we're talking about a small upgrade for this year, for 2026, from 2.3 to 2.4%. Unemployment rate, they still foresee it at 4.4%. They see higher inflation, especially bigger change in headline inflation, which includes volatile energy prices. They see it at 2.7%. Remember, it's their measure, the one they prefer, PCE, not CPI, at 2.7 versus 2.5 last time. Sorry, 2.7 versus 2.4, and core PCE, which excludes energy, with a small rise of only 0.2, but also going up to 2.7. So all in all, what I see here is that the Fed is not trying to rock the boat. They are nodding in acknowledgement to the rise in inflation already seen in their core PCE figures before the war. What I see here is that they're not responding directly to the war, taking it as something that wait and see. No change in the unemployment rate forecast, at least not for this year, very minor for next year. So I see them conveying here a message of calm, of we're in control, we'll have to wait and see, and we'll react as needed. We have questions about gold and silver. We didn't touch on silver beforehand. Ian, do you have a white hot silver chart for our viewers and listeners?
It's actually one of the ones that I haven't broken down today, believe it or not. But I will take a look at silver from a technical perspective, and it was something that we talked about before in the Discord channel. Was the fact that we were in this expanding wedge pattern. So expanding wedge patterns have a bias to break to the downside. What I now believe is happening is that we're in this pattern here. So we're moving lower within a fifth wave of an Elliott wave formation. So impulsive move to the downside, choppy overlaying price action, which we talked about before with Bitcoin. When you see these waves overlaying, it's a warning sign that it's indecision and corrective. We then get an impulsive move to the downside, a corrective three wave pattern to the upside, and then a move lower. So for me, the medium term bias is still bearish. I'll be looking for a move down towards sort of $73.90. Resistance is currently located at $78.82, and that's really a mirror of what we're seeing in gold as well at the moment. The medium term bias is still to the downside, but we're in this sort of last leg of the sell-off before buyers are probably going to return in silver and gold.
All right. So I'm taking another look at the statement. What I see at the first paragraph is two uses of the word some, which means moderation here. The unemployment rate has shown some signs of moderate stabilization, and inflation remains somewhat elevated. Again, not trying to rock the boat. I think so far they're more or less succeeding. We don't see extraordinary movements. But remember, we're going to see the decision, the press conference from Jerome Powell. And we have a question here after the press conference. What do you expect, dovish or hawkish? I expect Powell to try not to rock the boat. Again, to say we're in control, everything's okay. But I do think he'll lay down the two options of if inflation is temporary or transitory, he doesn't like that word anymore, then they'll have to keep rates higher, but no big deal. And if it's a totally extraordinary thing, he'll probably not want to talk about it, but then it could cause a recession. So he will mention these options. Remember that Fed Chair Powell, this is his penultimate rate decision. He finishes his job as chair on May 15th. So he has one more decision after this one. Yeah, and we have a question here.
From me.
For you.
Yeah, I've posted that. I just I want to give the viewers a sort of a a technical and potentially fundamental outlook of what I believe is going to happen for the rest of this week and potentially sort of moving forward. So this is a random chart. It's the Aussie against the Canadian dollar. And I think it's really, really, really important to get this is my bias for the week ahead. So if we see a move to the downside in the Australian dollar, it normally means that we're going to see risk off. Okay, can see a lot of patterns in stock indices that suggest lower levels, especially the DAX, believe it or not. So that would then push the Aussie to the downside. Now, Canadian dollar benefits from higher oil. We've already talked about the fact that we've got oil in that flag formation. So the bias is to break to the upside. So what we try to do, or what I try to do when I'm looking for trade setups, is use correlation and use different products to confirm that I'm on the right side of the trade. And what happened earlier today is we saw an aggressive move to the downside in the Aussie against the Canadian dollar. And that was when we obviously, Yohay discussed it earlier, gas infrastructures being attacked. The prolonged war and the fact that oil is probably going to push to the upside. So this chart says to me that we're going to see lower stocks and higher oil. And if we look at it from an Elliott wave perspective, then what we're basically forming here is a 5-wave pattern. So currently completed wave 1, we're correcting higher in wave 2. We've got a supply zone located at 0.9725. We've done educational videos on supply and demand. Then a move lower to form a 3rd and 4th wave, and then a move to the downside. So this says to me that this week we're going to see higher oil prices, lower stocks, and again, they're correlated. But is it a medium-term or long-term change of trend? And this is when we need to use sort of time frame analysis. So going to the weekly chart, we can see that we're reacting lower from this 161.8% extension level. So again, sort of combining time frame analysis, it basically says that this is only a temporary move before we move again to the upside. So again, using correlation, using charts, using technical analysis, it suggests that we will see a move lower in stock indices, but that will be temporary. We will see a move higher in oil to peak out probably when we've hit that flag formation, and then oil will move to the downside, stocks will move back up, and this cross currency will move to the upside. That's my sort of magic sauce, if you like. And we've got Clay with us.
Stocks. So yeah, you mentioned stocks, and that's a perfect segue to bring in Clay Webster of FX Reads, our stock guru. Clay, how are you doing?
I'm doing quite well. How are you?
Not too shabby. Here with you both.
Can't complain.
Amazing.
So the U.S. stock indexes were already slightly down coming into the decision today. The Dow Jones was down about 1%, and the S&P 500 and NASDAQ were both about 0.7% down. The decision and the dot plot, it really only helped a little bit. It went up about 10 to 15 basis points last time I checked. So it hasn't really made much of a difference, but I have a few charts I can run you through real quick.
Go
here.
ahead. Yeah, and while Clay prepares his charts, for anybody joining us, we're around halfway between the decision. The Fed decided to leave interest rates unchanged as expected. They foresee 1 interest rate cut this year, and in 15 minutes, Fed Chair Jerome Powell is going to meet the press. That's when we might get a bit more action. So Clay, what do you see on your charts?
Well, since the advent of the war about 19 days ago, we see that the only thing that's really working in the U.S. stock market, or oil and gas, ETFs and stocks. This one, XOP, is a really popular one. It's up about 12% since the war started, but just about everything else is negative. The Dow Jones is the worst. It's down about 5%. And then some of the ones that are a little bit more full of tech stocks, like the NASDAQ, they're only down about 1.5%. Overall, I think most people realize that this is kind of good in a sense. It's really limited downside since the war happened, and the war could be scaring the markets much more than it is. But when we look at the whole year, you can really see this better. RTY down here is the Russell 2000. This is a much broader mix of stocks than you see in some of the major indexes. They were up about 6% in January, but they just went negative today. And still you see oil and gas stocks all the way up 36% this year. It's the only thing that's working. If you look at the sector ETFs that are the most popular, basically everything on this 1 month here, everything is working. I would say nothing is working except energy right here, up 9% in the last month. You see materials, you see financials, consumer sector, everything is down. So this is basically, it's what you've already been saying. Essentially, it's just that people expect there to be more inflation with the rise in oil prices. But the thing to remember is that it really only matters if that higher oil price is prolonged.
Yeah.
So if the war were to end tomorrow, the oil price wouldn't go back to $67 if we're talking about WTI. It would take a while to get there. That's because a lot of oil infrastructure in the Persian Gulf has already been affected or destroyed, or in some cases, oil fields have been taken offline.
Yeah, they just don't have enough storage.
They don't have enough storage. Storage tanks have been hit by missiles as well. So this is something that will take 90 days at the very earliest, even to get back to some type of normalization. So we're going to have high oil prices for a while. The question is really, if we can get oil prices in the US below $90, there's less a chance that we'll go into some type of recession.
Okay.
If you look over at, say, Polymarket, they have a 31% chance at this point. It was higher at about 43% back on March 8th, but it's down about 31%. Goldman Sachs says there's a 25% chance of a recession this year. But those odds go up every single day that the war, continues.
Yeah. So I learned here two things with the number 90. So we need oil to drop under 90 to avoid a recession, sort of a
$90 in the US, and Brent needs to stay under 100. If you look at most of the analysts in oil, they really expect higher prices. So I would say that equity analysts or equity market is a little bit more optimistic than some other markets. They think that some ceasefire is going to happen here. I'm more bearish on that prospect. I think this war is going to last a lot longer than people think.
Yeah. It turns into a war of Hormuz, war of attrition. So energy sucking the energy out of other stocks. Before the war, we talked a lot about AI, of course, and tech stocks. We have a question here about the NASDAQ 100. Where do you see it going? What's going on over there?
I think it'll just stay in consolidation mode for a while here. We've really been consolidating since at least November, and some of the other indices since about September. So this consolidation has been going for a while. That's partially because we ran up so high last year between the April tariffs and then, about November. So it's been in consolidation mode. People don't really expect that we're going to get many interest rate cuts this year. So there's less of bullish fire underneath the market at this point. And at this point, people really want to see what happens with the war. But for now, the market's kind of in consolidation. The S&P 500 is slumping a little bit, but it'll only get bad if oil prices stay elevated past about mid-May.
Yeah,
that's when the market could get really hurt.
Yeah, that's when the potential Trump-Xi summit, leaders of the US and China, the world's most largest economies, are set to meet, more or less. And so we'll mark that on our calendars. And at least there's no more talk about of an AI bubble, or at least other talk about energy, about the war.
Right.
Well, that
Yeah.
talk is not that.
Nvidia still has a lot of headlines, but it's the share price sitting at about $180. People just are less interested in it now. There's going to have to be some other kind of news to get the rally going again.
Clay or Ian, do you have a NASDAQ 100 chart to look at?
Yes, always.
Okay.
I'm a bear.
How can you not be?
Exactly. I mean, I'm with Clay. You know, it's much easier to sell the index than it is to buy it at the moment with everything that's happening in the Middle East. Quite an interesting formation that's happened today. This sort of aggressive sell-off here. If we push it out to an 8-hour chart, this is actually a 4-hour chart that we've got in front of us, but if you push that out to an 8-hour chart, that's produced a bearish outside candle. And those candles are often seen at the top of a trend and the start of a new downward bias. Now, cipher pattern analysis, which is a technical analysis tool that I use, would highlight that we're still going to see lower levels. Again, is this going to be reflected from today's meeting? Potentially not, but I think with higher oil, as we've discussed, I think that's going to put downward pressure on NASDAQ. Now, we've got two formations here that they're slightly out of sync. We've got a butterfly formation that's located at 23,638, and then we've got a crab formation located at 23,142. What I'd like to see, and you don't always get what you want, is for the index to stay below this resistance level at 24,800. That outside candle will be broken if we see a move above 25,030. And then the whole pattern is negated if we see a move above this swing high, which was located at 25,198. So personally, I'm a bear, and it lines up with my sort of correlated stance, if you like, of Aussie against the Canadian dollar lower, push stocks lower, oil higher, and then we've got this nice correlation.
All right, thanks, Ian. And Clay, before we get ready for the presser and let you go, any last comments?
Nope.
All right, so thank you very much for your guest appearance here. We have 7 minutes to go until Fed Chair Jerome Powell takes the stage. And we have a question here about the ugly environment. We talked about China. Will China stop buying gold? My answer is no. They're accumulating gold for the long run. In general, their strategy is always very, very long term. So that's my answer to the fundamental question. I think they are responsible for some of the dip buying we're seeing. It's not only coming from retail traders. In general, gold has been in an uptrend for quite some time, with the occasional air pocket falls. And we already covered the gold chart. So let's take a look at dollar yen, which usually tends to be the currency pair most impacted by U.S. macroeconomic events. Ian.
Yeah, we've got some nice correlation here again. So again, going back to technical analysis, what we're looking for a lot of the time is for levels to line up. So, you know, if we're looking for corrective levels, we might be looking for supply and demand zones. When we're looking for Fibonacci extension or sequences, what we want to see, again, is for certain levels to line up. What we see in the US dollar against the Japanese yen at the moment is this impulsive move to the upside. And we've got this Fibonacci extension level. It's a 161.8% extension level, and that's located at 161.07. And we can see that even though we're getting mild dips, they continue to find buying interest. And I believe that we're currently within a fourth wave in an Elliott wave pattern on the daily chart. Now, if we go out to the 8-hour chart, that level there, 161.07, it correlates with this butterfly formation. So at the moment, I'd say the bias remains to the upside. But when this 8-hour chart hits this butterfly formation, then there's a very good chance that we're going to see a move to the downside in a fourth wave correction. So at the moment, I'm bullish. As always, I always prefer to buy into dips. There's support located at 158.12, resistance at 161.07, and we can't forget the rumored Bank of Japan intervention level, and that comes in at 160.00. And again, that's just a rumored level. Personally, I believe that the Bank of Japan is probably going to step aside. I think there's probably too much macro noise out there at the moment for them to be able to.
Interventions work best. I mean, hitting it when it's already falling down, not going against the trend. So yeah, I think they'll wait for a better opportunity.
Yeah, I think they'll let it go past that level. I think there's too many macro drivers for them to make much of an impact if the market wants to take the dollar in that direction and to push the yen to the downside. So bullish bias basically.
Yeah, got it. We have a few minutes ahead of Powell. We talked about the Japanese yen, Asia. So another thing to mention is that the Bank of Japan is set to announce its decision. For us, it'll be very early in the morning. It'll at night, morning, midday in Japan. No changes expected. The Bank of Japan is expected to leave interest rates unchanged at 0.75%, but they might leave an open door for a hike in April in their upcoming decision. We had a quick question about India, about the Indian stock markets. India is an oil importer. It suffers from the war. The Indian rupee has hit fresh lows against the US dollar since the outbreak of the war. But Iran did allow some oil tankers headed to India to make the journey through the Strait of Hormuz. So it's a bit of a complicated situation. India is sort of has this tradition of being a non-aligned nation, and it's in a tough spot between the U.S., China, Iran, all that. Yeah, we have 3 minutes until Powell. So here's what's going on in the press conference. So Fed Chair Jerome Powell will take the stage in 2 minutes. He always reads from prepared remarks, basically talking about what we heard in the statement. And then the juicy part comes when reporters ask him the juicy questions about what's next for interest rates, inflation, unemployment, and his personal future. So we'll be putting him a bit on mute. You will be able to react, and we have here's the press conference. We're saving you the music. They change the music from time to time, and Paul will soon enter the room. Yeah. So Ian, you said there's another safe haven currency. It's the Swiss franc.
If we can squeeze this in just before the presser. This was actually
headlines. I'll cut you off.
Yeah, this was a setup that we talked about last week, and again we've done a lot of educational videos within our YouTube channel, and we talked about the fact that if dollar Swiss broke to the upside and then came back and retested this cloud cover or cloud base as it is now, that would be a potential buying opportunity, and we are seeing a move to the upside. So obviously dollar strength, I think that will continue over the medium term, and potentially Swiss losses. Swiss National Bank has been quite vocal in the fact that they don't want to see a lower Swiss franc. So you've got quite a decent sort of macro background and technical background with regards to this setup that we mentioned when we were covering the CPI, I believe it was last week.
Yeah, I'll just pause you for a second. Powell has begun his press conference, as you can see there on the screen, backed by the American flags. At the beginning, he reads out from the statement. I'll just mention once again, the Fed has two mandates, is price stability and unemployment. The latest jobs report was bad, disappointing, a drop of 92,000 jobs, but could be a one-off due to various reasons. Inflation, according to the measures the Fed uses, they're still a bit uncomfortably high, 3.1% core PCE, and the Fed wants 2%. So far, he's reading the statement, and we'll join when he gets questions from reporters. One thing I hinted at is his future. He finishes his job May 15th. His nominated successor is Kevin Warsh, formerly at the Fed, used to be a hawk, now in favor of cutting interest rates. There's uncertainty about his nomination process, but Chair Powell could continue as Fed governor, and I mean, still breathing down the neck of his successor. I expect Powell to refrain from answering that questions. So far as reading the statement, and I think we can go back to Ian for you to complete what you said about dollar Swiss. If
I've finished that analysis.
Okay. Sorry for. Okay, so I didn't cut you off.
Demand has clearly softened as well.
Here's the
Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE.
Well, we seem to have
prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all
he
Americans.
repeats the usual stuff.
We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people.
Small risk-off reaction.
Thank you, and I look forward to your questions.
Questions begin. Juicy stuff. Let's go.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Yeah. Opening the door to no rate cuts. That's hawkish.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumer's going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
No one knows. Relatively hawkish.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on
Okay, so we're already 15 minutes into Fed Chair Powell's press conference. And if I would have to use one, okay, I'll use two words, relatively hawkish. Okay, we had a few things. So the Fed tries not to rock the boat. They're trying to say the main message is meeting by meeting decisions. And regarding the war, we do not know. But a few things stood out to me. First, on inflation, he stressed that inflation was creeping higher unrelated to the war because of tariffs. Okay, so and once again, core PCE is 3.1. The goal is 2%. Not great. Interest rates are now around 3.6%. So there's not much more to lower them. Secondly, he didn't even mention the jobs report, if I'm not mistaken, but he said, the change rate is solid and stressed that the economy is doing well. If the economy is doing well, inflation is rising unrelated to the war, and doesn't seem concerned about employment, well, no rush to cut interest rates any time soon. And we're seeing a bit of this risk of reaction. The US dollar is a bit higher, gold and stocks are a bit down. And yeah, Ian, what do you have on your chart? We got a question about silver, so maybe we'll start from that and move on to other assets.
Yeah, I mean, my outlook is still the same. I believe that we're going to see this sort of continued tick to the downside. I don't particularly like the saying, but the trend is your friend, and at the moment, the trend is definitely to the downside in silver and gold. I still think this is a great technical level. I wouldn't extend past it because I do believe that the dollar index, which is the DXY, that's going to spike to the upside and then push lower. So yeah, I think 73.91 area is going to be a good technical level to focus on. And then I'd expect a correction to the upside. I don't think that the correction to the upside is going to be extensive. It depends what sort of chart, what time frame you're looking at. But I think sort of up towards this pivotal area. So we've got a previous swing high here. You can see it's sort of been mid-range, cutting through the center of this price action. I think around about $82.50 will be a reaction high. And then we'll have to reanalyze. You know, these are very, very fluid markets at the moment. Bearish buyers.
Yeah, we're seeing, so for those of you joining us right now, around 47 minutes ago, the Fed left interest rates unchanged as expected and left its forecasts unchanged. But then some 17 minutes ago, Fed Chair Jerome Powell began his press conference, and it seems like he, talked up the US economy, but stock markets don't like it because that means no interest rate cuts. And the one beneficiary is King Dollar. And we have a question about dollar index. What do you see, Ian?
Okay, so we are ticking to the upside with gold and silver moving lower towards their target levels. Now, for me, I'm always wary of impulsive moves and then free wave corrections. So basically what normally happens in the market is we get aggressive reactions in one direction. The market then corrects lower. People think that the correction is complete. They jump on top. It will push higher. And that's what I'm seeing now in this BC leg. But then without a breach of the previous swing high, sellers can quite easily re-emerge and then take it down in this CD leg. So yeah, at the moment, the bias is to the upside. And again, I'm just noting that somebody said DXY is above 100. You've got to be careful which DXY index you're looking at because different providers have different prices basically. And my price on capital.com is 99.77 at the moment. So yeah, the initial bias is still to the upside. But I'd watch those key levels in silver, the completion of that 261.8% extension, the completion of gold moving to the downside and hitting that support level will probably signal the top side in this BC correction. And then we'll see a move to the downside. Markets have a tendency to wrong foot people, especially during these sort of events.
Yeah, I must say I expected Powell to lift stock markets. It happens quite a few times in response to his press conferences. And his message was, for me, we don't know what's going on, but we'll do what's needed. And so far, the US economy is doing well, but markets seem to be in a bad mood. Well, I'm also in a bad mood. There's a war going on, so it doesn't surprise anybody. For me, perhaps we talked about silver just now, and we're seeing also gold. I know it's a popular asset, drifting further away from that 5,000 mark, but still not at the lows seen earlier today. Anything to add on gold, Ian?
No, just with the DXY, the dollar pushing up slightly. I think we're going to continue to see a move to the downside towards 4,795. This just looks to me like a period of consolidation, believe it or not, even though we've seen sort of sellers return. What we do get is these areas, the Wyckoff theory, and I won't go into too much technical analysis, but the Wyckoff theory basically says that we go from impulsive moves to consolidation, and we can see this sort of quite clearly on this gold chart. So at the moment, a period of consolidation, but it still has a bias to break to the downside. And just to go back to sort of technical analysis and Wyckoff theory, etc., what has a tendency to happen is when we finish the sequence is that we spike to the downside out of the consolidation, and then buyers return. So basically what they look to do, or what institutions are rumored to do, is basically accumulate gold in this area, then spike to the downside, take out stop losses which are below this previous swing low, and then push back up, and then you see sort of a corrective sequence to the upside. So could quite easily stay in this range for this evening, but again, it's still got a bearish bias over the short term. But I think over the medium term, people are going to get wrong-footed on this, and it's going to pop again.
Yeah. So yeah, we're already 20 minutes after Powell began speaking. He was relatively hawkish, not indicating no rush to cut interest rates anytime soon. To conclude it, and we're seeing sort of risk-off moves: stocks, gold, silver down, US dollar up. One chart for me that stands out. Well, I see you have stocks over there, Dow Jones. And then you have anything to?
Yeah, so just to sort of add to what we talked about earlier, you know, you can have one chart that gives you a bias over multiple different charts, and that's it goes back to the way that I use, or how I analyze markets, and it reflects all the way back onto that Aussie against the Canadian dollar chart. You know, Aussie lower, stocks lower, and that's what we're seeing at the moment. So, you know, US 30 is breaching this previous swing low. It's gonna grab liquidity on the way down. This is impulsive. It was an 8-hour outside candle, as we said. You don't want to be standing in the way of these trends. And the trend to me for stock indices at the moment is clearly to the downside. And maybe we just switch over. We've talked obviously about US stocks, US 30, NASDAQ. But when you look at European stocks, they look pretty dire as well. I mean, this is the DAX, this is Germany 40. And again, what I like to see is correlated levels. So on here, I've just written correlation. So again, going back to sort of Elliott wave, don't get stuck on the wrong side of the trade. This is just a period of consolidation. We've got a daily 261.8% extension level around about 22,000. And if we pull back to a shorter time frame, and again, this is something that I like to preach, which is time frame breakdowns, looking at the big picture, then going down into shorter time frames to try and get a bias. And you can see it's just clipped resistance. I don't think it was earlier today. I think it was yesterday. And we've seen this aggressive move to the downside. 21,844 is very, very close to that daily 260 1.8% extension level, which is 22,000. So again, correlation, stock indices lower, oil higher, Aussie CAD to the downside, and you get this nice sink, or you get this, correlated factors that can give you good setups across sort of a myriad of different products.
Yeah, when the orchestra, everybody's in the orchestra is playing in the same hymn sheet,
Exactly.
It sounds better, and
Yeah.
it becomes more tradable when it comes to.
And again, just from my perspective, being sort of quite an active trader, sometimes you need to look away from the products that you might want to trade. So you might want to trade gold, or you might want to trade silver, or you might just concentrate on the euro against the US dollar. For me, you've got to broaden your horizons. You've got to really look at, a wide spectrum of different products. You can still go back to the euro, dollar, or gold, but use the correlation that you're getting from other products and reflect that back onto the products that you do want to trade.
Yeah, it's like we're in the media. Good journalists corroborate, and so do traders. They find evidence to their trade also in other charts. So we're getting close to wrapping up the show about live coverage of the Fed decision. So the Fed left interest rates unchanged as widely expected. It said that they don't know how the war will impact prices, how much it'll push other types of inflation up except energy, and if it'll even be worse. But it seemed that Fed Chair Jerome Powell sort of dismissed that extreme scenario. More importantly, he said that the US economy is doing very well. He said inflation was already a bit too high, somewhat elevated before the war, and he didn't seem to be worried whatsoever about the labor market. The response came only after he spoke, answering some questions, which we covered for you live. And we saw the US dollar go up, gold fall, and stocks fall. I would have expected that by saying the US economy is doing well, we could see stocks go up. But all this comes on the background of a war. Today there was an intensification, an escalation. Israel, with the help of the United States, bombarded gas fields called South Fars. And that means an upstream. That means somewhere that produces oil, not exporting oil. And Iran vowed to retaliate in 3 Gulf countries. That ruined the mood for markets, which were much more positive yesterday, in hope that oil could come out of other regions, and in general that the war would end sooner rather than later. It would be a matter of 4 to 6 weeks. So on that background, the Fed sort of said, well, we'll wait and see, but they don't seem in any rush to cut interest rates. And we saw the reaction on the charts. Ian, any additional comments? Anything that stood out to you in the charts that we've covered today?
Yeah, just the macro picture seems to be aligning with the charts, which doesn't often happen. But we've got this, sometimes we get a bit of magic sauce that we can sort of sprinkle on the charts. And at the moment, that's saying to me, be careful, don't stand in front of these trends. Stocks to the downside, oil up, wait till these trends have finished and completed, and then, reevaluate. And of course, we're going to be back next week, I believe, on for a live trading session or live analytical session, and we'll be looking forward to updating everybody on these market moves.
Yeah. Stay tuned. Follow FX Rate on YouTube, X, Instagram, TikTok, WhatsApp, Telegram. We're everywhere. And we love covering markets. We're really excited about them. And we're so happy to get your questions. It makes things more interesting. And we love helping traders wherever they are in their journey. Okay, so I guess we're, it's the top of the hour. Thank you very much, everybody, for joining our live coverage of the Fed today. Thank you very much, Ian Coleman.
And thank you.
Okay.
It's always a